Good morning and welcome to the Morning Bell. I'm Robert, joined by Lizzie and Steve. It's Tuesday, March 3rd, 2026, and we have a lot to cover today. Lizzie, what are the main themes you're seeing in today's news?
Thanks, Robert. Well, the dominant story right now is the escalating Middle East crisis and its ripple effects across global markets. We're seeing oil prices spike significantly as Qatar has halted output at a major LNG facility, and this is creating real volatility across both stocks and bonds. The Financial Times is reporting that stocks and bonds are tumbling together as the widening Middle East war rattles markets, which is particularly concerning because it eliminates the traditional safe haven diversification investors usually rely on. What's really interesting is how this is playing out across different sectors. Energy markets are obviously front and centre, with aluminum rallying sharply as the Iran crisis prompts production halts. But we're also seeing Treasury yields rise, even as investors typically flee to bonds during geopolitical uncertainty, which tells us that inflation fears are overriding the safety trade. On the corporate side, we're getting mixed signals from retailers. Best Buy's holiday sales disappointed, though they're showing some progress in growing profits. Target had another lackluster quarter, but management is saying they're on track to end their sales slump. These consumer-facing companies are giving us a real-time read on American spending patterns, and frankly, it's not painting a robust picture.
That's a significant development, especially with the traditional safe haven assets not behaving as expected. How are you reading the market's interpretation of all this? And what does it mean for traders right now?
The market is clearly in a risk-off mode, but it's a complicated risk-off environment. Normally, when geopolitical tensions spike, you'd see a clean flight to quality with bonds rallying and the dollar strengthening. Instead, we're seeing Treasury yields extend their fall as traders slash Fed rate cut bets, according to Bloomberg. That's because the oil shock is reigniting inflation concerns, and the Fed's hands are tied. For traders, this creates a challenging environment because the usual playbook doesn't work. You can't just rotate into bonds and call it a day. What I'm watching closely is sector rotation within equities. Energy names are obviously benefiting from higher oil prices, but you need to be selective because not all energy exposure is created equal. Companies with strong balance sheets and pricing power are going to outperform. On the flip side, consumer discretionary stocks are under pressure from multiple angles. Higher energy costs eating into margins, weakened consumer sentiment, and the threat of persistent inflation keeping interest rates elevated. The Wall Street Journal headline about what hotels are telling us about America's economy is particularly telling because travel and leisure spending is often an early indicator of consumer health deterioration. I'd be looking at defensive positioning here, focusing on quality companies with pricing power and strong cash flows that can weather this storm.
That selectivity is going to be key in this environment. Steve, let's get into the economic numbers. What's the picture looking like from the data side?
Thanks, Robert. Earlier this week, we got the ISM Manufacturing PMI on March 2nd, and it came in at 52.4, which beat the forecast of 51.8, though it was down slightly from the previous reading of 52.6. This is still in expansion territory above 50, so manufacturing is showing resilience despite all the cross-currents we're dealing with now. Looking at today specifically, we don't have any major economic indicators scheduled for release, which actually gives markets a bit of breathing room to digest the geopolitical developments and position ahead of the critical data coming later this week. And that's where things get really interesting. Wednesday, March 4th, we're getting the ADP Employment Report with a forecast of 50K, up from the previous reading of 22K. This is going to be an important preview for Friday's main event. Then on Thursday, March 5th, initial jobless claims are due with a forecast of 215K compared to the previous 212K, but the real focus is on Friday, March 6th, when we get two major releases. Non-farm payrolls is forecasted at 60K, down from the previous 130K, which would represent a significant slowdown in job creation. On that same day, we're also getting retail sales with a forecast of 0.3% growth. These Friday releases are going to be critical because they'll either confirm or challenge the narrative about economic resilience that's been supporting markets. If NFP comes in weaker than expected and retail sales disappoint, that's going to add another layer of concern on top of the geopolitical and inflation worries we're already dealing with.
Those Friday numbers are definitely going to be pivotal. Lizzie, let's shift our attention to crypto. What are you seeing in the digital asset space, and how is it responding to all this macro volatility?
The crypto market is showing some really interesting dynamics right now. Bitcoin is in a neutral to bearish position at the moment, trading in that critical zone where we're seeing mixed signals. On one hand, we're seeing strong institutional interest with spot Bitcoin ETFs posting 458 million in net inflows on one of the quarter's biggest inflow days, which suggests that some institutions are actually buying into this global instability as a hedge. VanEck's CEO is suggesting that Bitcoin may be forming a bottom as the 4-year cycle ends, which is an important technical perspective. However, there are concerning signs too. Bitcoin futures demand has fallen to 2024 lows, which indicates waning institutional participation in the derivatives market. We're also seeing a potential death cross forming on the price chart, which historically signals late cycle bear market conditions. The key level to watch is around $70,000. Bitcoin briefly touched that level amid the Middle East tensions, but has since pulled back. What's notable is that Bitcoin holders are showing zero panic despite the volatility, which suggests strong conviction among long-term holders. For Ethereum, the picture is more bullish. We just saw Bitmine, backed by Tom Lee, purchase another $103 million worth of ETH, bringing their holdings to 4.47 million tokens. This kind of institutional accumulation is significant, and we're also seeing positive developments with Chainlink bringing Coinbase's CBBTC to managed DeFi through CCIP integration, which could add about $5 billion in Bitcoin-backed liquidity to the ecosystem. Ethereum is benefiting from both institutional investment and improving infrastructure. Solana, on the other hand, is facing headwinds. There was a situation where a Solana-based meme coin crashed by 75%, and the Japanese Prime Minister had to disavow it, which has created some negative sentiment around the ecosystem. Solana is testing some critical support levels and risks falling further if it can't hold current price zones. The broader takeaway for crypto is that institutional money is still flowing in, particularly to Bitcoin and Ethereum, but retail sentiment is more cautious. The correlation with traditional risk assets remains high, so if equity markets continue to struggle with geopolitical and inflation concerns, crypto will likely face pressure in the near term, despite the long-term institutional accumulation trend.
Well, that wraps up today's Morning Bell. We've covered a lot of ground from geopolitical tensions affecting energy markets to critical economic data coming later this week and the evolving crypto landscape. Remember, do your own research and consult with financial advisors before making investment decisions. If you found today's discussion valuable, please subscribe to the Morning Bell so you never miss an episode. I'm Robert, and on behalf of Lizzie and Steve, thanks for listening, and we'll see you tomorrow.